The summation of this is actually 34,050. Now, the last thing that we are going to do here, we are going to make an adjustment for reserve for unexpired risk. We also call this reserve for unexpired risk the provision for unearned premium. Unearned premium, when you see that term, unearned premium or provision for unexpired risk, it remains the same. And what we do is we less unearned premium carried down at the end of the year. We less the unearned premium at the end of the year. I can take you through a lot of theory to explain how we come about this unearned premium and some actuarial stuff, which is not purposes of this class. What I need to guide you through is revision and how you tackle this. So this unearned premium at the end of the year is 200. If you read that, this section 19, you see deducting therefrom provisional, provision for unearned premium or reserve for unexpired risk, preferable for that class of business at the end of the year, then adding thereto the provision at the beginning of the year. It means we come here and add an unearned premium at the beginning of the year. Your unearned premium at the beginning of the year is actually 1,000. So, considering this, we'll arrive at 34,050. These are our incomes. Those are our incomes. 34, not 050, it will become 850 because of 800 over there. So moving on, we now have to determine our expenses. Our expenses for the year. Expenses for the year. Only the allowable. Remember, we are using that format where we take the taxable incomes less allowable expenses. So our expenses here, we start with claims expense. Now, claims paid. Claims paid, let me look for it. Claims paid is 4 million. Then I'm going to add payable, carry it down. That is payable at the end of the year. Payable at the end of the year is given as 900. Then I less payable, BD, at the beginning of the year. Remember, we are accounting for the expense for the year, the expense that has been incurred, whether it has been paid or not. So this has been incurred this year, this payable carried down. This one brought down is actually payable, rather it was payable in the previous year, though it was not paid. It's not an expense. We should not account for it as an expense here. So we less 600, and this will give us 4,300. I'm not yet done with this expense of claims. The next item that affects claims, we see there's legal expenses. Before legal expenses, let me talk about claims recovered from reinsurance. We call them reinsurance recoveries. They are not going to shoulder all the claim expense because they are insured. They are insured. So part of the claim expense is going to be settled by their insurers, and for that reason, we'll not consider the entire expense of claims. We only consider the net after deducting these reinsurance recoveries of 3 million, and we are left now with 13. Then there is legal expense. The examiner is clear that this legal expense relates to insurance claims, and the legal expense is actually 400, but we go down there and see there's a tax dispute being settled. Expenses in connection with payment of taxes are rather not allowable. So we less that 100, and this is going to give us 300. So our net claim expense becomes, let me push it here, becomes 1,600. Because there are deductions against income, I put them in bracket, our net claim expense. Then the next item that we consider are now those expenses relating to insurance, agency fees. Agency fees is given as 400, all right? But I also draw your attention to note number 4, which talks about the claim expense, rather the agency expense of 200 that relates to another class of business. Remember, for purposes of taxation, we have to separate between general insurance and life assurance. They are separated, they are treated totally differently. So we less these 200 that relates to life insurance, and our expense becomes 200, our claims expense. All my expenses, I put them in bracket because I'm using the outer column, which has incomes. This one was for working. Now, I have management expenses. Management expenses. No explanation concerning this. Is actually 120. Management expenses are allowable. Entertainment expenses. Not unless otherwise advised, which will indicate that entertainment expenses are not allowable. Entertainment expenses, businesses would invariably incur expenses under entertainment, and is actually an allowable expense. So the expense is 400 over there. Then the next item that we need to consider is there's commission on reinsurance accepted. Commission accepted. They are not putting it in full. Or let me use it the way they do. Commission accepted. 20. Remember, all these are expenses, therefore deductions. And looks like we are coming to the end of the question, because the next item that I like to adjust is now this capital expenditure on purchase of furniture and purchase of computers. So these ones are no qualifying expenses, but they qualify for deduction on wear and tear. So we are going to deduct wear and tear allowance. For the furniture, we consider the cost 600,000. We multiply by the rate, which is 12.5%. And for computer, the rate is, rather the amount is 300, and the rate is 30%. So we can compute, this would actually be 90. 600 would be 75. 600 would be 75, right? So wear and tear on this one, 75. I deduct. Now, these are the allowable expenses which we are going to offset against this income. This is our total income, and these are our expenses. So I can determine the total of my expenses, and then let me put that total over there, total expenses. Then from total expenses, I'm going to less it from this income, the total of my income, and that will give me my taxable income. Listen here, there's an expense that we did not consider, bad debt provision. Why we did not deduct this bad debt provision is because it is a provision as they put it. If it is actually a bad debt expense written off, then would allow it as an allowable deduction. But a provision, tax laws are actually against that language of provision. So I want to calculate the total of these expenses, and this will give us 2505. With 2505, I less it from my total income. So my taxable income becomes, I less it from 34,850. I get a taxable income down here of 32,345. That is my taxable income, and is what the first part of the question is testing for 8 marks. We compute the taxable income of this insurance company. The final bit that we need to conclude with is now the actual tax computation. The actual tax computation. Allow me to use the space here. The tax computation. For the final 2 marks, I take my value, 32,345, I multiply by 30%. And this will give me my taxable tax payable. Now this, let me call it gross, because there's something else that I'm going to do, of 9703.5. Now I'm going to less withholding tax. Now look at this. These two incomes attract withholding tax. These two incomes attract withholding tax. There's some tax that has been paid on this one, 15%, and on this amount, they have also paid taxes at the rate of 15%. So on the bank interest, the withholding tax is actually 15% of a million, 15% of a million, which is actually 150. And then on the treasury bonds, again is 350 multiplied by 0.15. The withholding tax that had been deducted was actually 52.5. So we deduct those amounts, and this will give us the net tax payable, which is the final answer that you are looking for. And this is basically how you are required to compute tax for this insurance company. So thank you very much for watching this. You may write to me or call me for any clarification that you need. Follow this on our YouTube link, and we are grateful that you are watching.